Hi there, welcome to Starting Up and Right. I'm Trey Nicholson, your co-host. With me as always is Ryan Keating. Hey there, Ryan.
Trey, hello.
Yeah, this should be a fun episode. In the last episode, we got the opportunity to speak with Mark White, a startup attorney. And one of the subjects we discussed was management of the cap table, which kind of led into discussing stock options and red flags and how we manage stock. That kind of led into the conversation as well of how Carta has kind of taken a lot of the drudgery out of managing the cap table and freed you up to talk to people about stock options and cap tables. And so today, I want to follow that up with you have a presentation that you've given pretty successfully. So why don't you kind of reiterate that? How has your role changed? What's your current role, considering all the technology you use in dealing with stock options in particular this episode?
Sure. Yeah, it's a good question. And we've seen software platforms, in particular, something like Carta, really become widely used in the last, say, 5 years. And that has changed a couple things. It's been a great technology solution. It's really simplified a lot of the logistics of granting options and having the board approval and tracking the amount of option pool that's available when vesting happens. It tracks everything really well. And it's really eased the process of having options approved and even received by the recipients. But one thing we have noticed that it's kind of created a void is the conversation that would normally have taken place with the specific option recipient. Think of it as the employee at the startup that has received an option grant when they joined. It used to be that we would print out on hard paper a copy of the option grant, sit down with that individual and walk them through. Here's the number of shares you have. Here's what your vesting period is. Here's what it means if you were to leave or if you wanted to purchase after your first hurdle, 12-month hurdle is crossed. That conversation doesn't really happen anymore because the recipient is now notified via Carta. They go into Carta or other, and they receive that option. And for the most part, they have access to reading through the agreement, but they don't benefit really from that conversation about what does it really mean to me.
Yeah, that makes sense. I would imagine in that process, they're coming onto a new job potentially. A lot of questions don't get asked, I would imagine, that probably need to get asked. And so I think this presentation that you're going to show us today is one that you've put together in particular to speak to that employee. Founders are definitely our audience here, and founders kind of need to understand two sides of stock options. But they may often assume that their employees understand stock options as well as they do. That's not always the case. So this is part of that conversation that you have with the employees, with the team.
Yeah, that's right. And we've been asked to put this presentation together a number of times for our clients. And it's really, as you've pointed out, to speak to the employees, to speak to the people that are recipients of the company's stock option. There is a separate conversation, as you pointed out, that takes place with the founders, with the board. And that's more along the lines of how large should our option pool be? How do we match our option pool to our hiring plan? What amount of options should we be thinking of granting to specific positions at specific stages of our company's growth? That's a separate conversation, which we have with our clients. This is entirely focused on what does it mean to hold an option grant within this startup is what we'll be speaking to.
Perfect. Well, with that, let's kind of shift gears here. The screen's going to change a little bit, but we'll come right into that presentation and just pretend like you're talking to a small team of employees at a promising new startup.
Okay, so Trey, this is the presentation or a version of the presentation that we have put together to speak to our clients, specifically their employees. And so I'll run you through this. And I know we have some questions at the end as well. So introduction to employee stock option plans. And as we mentioned, this is a conversation for the optionees, the holders, separate from a conversation that we would have to even design the option pool and what size it should be. So the first question we get is, what is an option? The term option literally suggests that you have the right but not the requirement to purchase the shares at a future date. So it's completely up to the holder. They can let these options go unpurchased and they don't own them, or they can decide to purchase them throughout their vesting period. Bottom line is, it's the right to purchase stock in the company at a predetermined price. And that's important. And we'll come back to that. What does it mean to have a strike price, and how is it determined? Why do companies offer stock options? The main reason is they want to attract and retain talent. It's especially in a startup, one of the main motivations for people to come into a startup is they want to grow the business. They want to participate in the growth and the value creation. And everybody hears stories, of course, about how stock options become very valuable as you start with a company and they grow and get acquired or eventually go public. Not to mention, it really aligns the founders, the investors, the employees. It aligns everybody with the same incentive, which is the better the company does, they all are participating in that creation of value. And then a topic that we talk about a lot with our clients is you really, as a startup, you have two forms of currency. You have cash and you have stock. The earlier you are in a startup's history, you usually see that stock is more readily available than cash. And as a company matures and grows and becomes cash flow positive and starts to stock up cash reserves, that relationship will change, where now stock is something you want to hold on to more and cash is maybe more readily available. So early stage companies, very early stage companies perhaps even, will spend a lot more in terms of the stock amount that they might award employees than, say, later stage companies. And as a company goes through those funding rounds or stages of growth, that will change. This next slide that I like to show, it's kind of a fun example of stock options. This is a pretty well-known story where a graffiti artist back in, I want to say 2006 or 7, way before Facebook went public and is the company we see today, agreed to basically paint the Facebook office for, I think it was a sum of about $60,000 cash. And instead, he opted to take stock options in Facebook. Certainly, we could all say in hindsight, we would have done the same thing. But at that point in time, there wasn't a lot of, you don't know. There's a lot of unknown. And that's one of the things inherent with an option is you're betting on the future. But he made a good bet. And his options, I mean, and this was back when this article was published, I think, in looks like 2012. His options were worth $500 million, 500 million. And you can imagine with how Facebook is doing today, if he still holds those options, they're worth quite a bit more. But that's a fun example that a lot of people are aware of, and obviously a good outcome for that graffiti artist. So when we talk about stock, even before we get to options, real quick, there are generally two forms of stock options in a startup. That's assuming you're a C Corp. Other companies that are LLCs, et cetera, that's a whole nother topic. We can, at a later date where you don't really have stock options, you have more membership units or ownership units. But for what we're talking about today, in your typical C Corp early stage company, you have two forms of stock. You have common stock and you have preferred stock. When we're talking about option grants, they are options to buy common stock in the business. The preferred stock is reserved for investors, generally your VCs at this early stage. The difference, which just in a nutshell, as it says here, is preferred stock has certain things around, liquidation and anti-dilution and voting rights. Common stock is pretty straightforward. They are the last to get paid after preferred, after debt, and that's what your options are made up of. And there is always going to be, when you receive an option grant, there is a equity plan that goes along with that to say, here's exactly what the common stock is entitled to in terms of, does it have voting? Most of the time, no. Does it have any other rights associated with it? And that will be spelled out in the equity plan. When you receive a stock option grant, there's two different varieties. very simply, and this starts to get into tax, and I do want to caution that when it comes to tax and individual tax treatment, um, every person should really consult with their tax advisor. It's a very unique situation in terms of your tax situation. But in general, you have incentive stock options called ISOs. Those are intended for employees, okay? And they have advantages on a tax basis. You can exercise your option to actually own the stock. And then based on the time that you hold that stock and the time that you sell it, you can actually have long-term or short-term capital gains. Just like if you owned any stock, let's say you went out and bought a share of Google or Apple. If you hold that stock for a year and then sell it, whatever you've made on that stock will be taxed at a smaller tax amount. If you buy that stock in Apple and sell that stock, say a week later, you're going to pay a higher tax rate called short-term capital gains. So for an ISO, you can exercise your right to buy the shares and not sell them. And if that holding period extends 12 months, then you're paying long-term capital gains when you end up selling the shares. NSOs, on the other hand, first of all, the main issue is NSOs are only for advisors and vendors. An advisor or vendor that's not an employee cannot have an ISO. So you use NSOs for your board of advisors, perhaps vendors that are willing to take some cash and stock, especially early on, again, when you need to use your equity as currency. It's a very common scenario. I mean, the graffiti artist is a great example. Facebook would rather have given him stock than parted with 60,000 at that point in time. And it worked out for everybody, but that's not an uncommon situation that you'll see vendors get into, especially early stage. They will often take some options, some upside in the company in exchange for some of their cash or all of their cash on their invoice. So when you are an owner of a stock option, and even as you exercise that stock option and you now own the actual stock, a question comes up a lot is, how do employees actually cash in? The most common way is that the company gets acquired or goes public. And in that case, there's an actual buyer for the shares. If you're still an employee or you're still vesting, usually what happens is you buy and sell that stock in the same transaction. So essentially, you're just taking the difference between your predetermined purchase price and the sale price that the acquirer or the IPO is creating. Other ways to do it, and this is becoming more common as we see companies basically stay private longer. Facebook is another great example. Facebook and a lot of other large companies like Facebook, they tended to take more venture capital and go to public markets later. So you might have had a 10-year holding period if you were an early Facebook employee where you have these shares and they're yours and the company's obviously doing well, but there's no market to sell. So these platforms like EquityZen is a good example. They've popped up, and essentially what they do is they allow you to sell your private share or your shares in private companies. Now it's subject to what your option allows you to do or what the equity agreement allows you to do. Some equity plans will say that the company has the right to buy them back. Some plans will say that you can transfer them, but the company has to approve. So this is something you need to check. But if you're not able to cash in on these because of a liquidity event, then you can oftentimes, again, find a platform that buys these otherwise privately held shares. Another example, and this is usually for early employees or mainly founders, they can sell some of their holding into the next round of financing. But that's in general for the employees that are holding these option grants, that's not something that's readily available. So the terms of the option grant, and this is a lot of this will follow if you have an option and you're an option holder, this will follow right down the main page in terms of all the, the number of shares, the dates, the vesting date, and we'll walk through this right now. This is the conversation that we would normally have when we would sit across the table and present the option grant to the recipient. So a lot of our questions come up on here. which are the very specific details of the grant and what does it mean to the holder of the grant. So first of all, the number of shares. Just as it says, it's going to tell you how many number of shares the total option grant covers. Okay. The exercise price. The exercise price, also called the strike price, is the price that is set on those shares for the entire length of that grant. So that price will never change. Ideally, what you see is you get the price issued at the time that the grant is approved. And then as your vesting takes place and you're earning your shares, say over 3 or 4 years, the value of the company increases. Even though the value of the company is increasing, your price doesn't change. This is the benefit. This is why you want to be an option holder. You have the ability to buy into the company when there's more value created, but at a price that was tied to the value when your option was approved. So this is how the graphic designer from Facebook was able to turn a $60,000 grant into $500 million, because the value of Facebook increased, but he was still able to buy his shares at that same price. The grant date. This is the date that the board approves the grant. For any grant to exist, the board has to meet. Now they can do it over something like CARTA and say, yes, these grants are all approved. That grant date is not going to necessarily tie to your hire date or even your vesting date. It's usually the day closest to your start date that the board meets to approve grants. Okay. Now, one thing specific about the grant date is the exercise price or the strike price has to be that current price as of the grant date. It's not tied to your vesting date, which can be when you started. It has to be tied to the date of the grant. The vesting commencement date is often your hire date. Again, this can be weeks, even months before it's actually granted by the board, but that's when your vesting begins. You'll get credit for vesting, even if it takes place weeks or months before the grant date. Now, the vesting commencement date and the vesting schedule are important. This is basically what you actually own. When you receive an option grant, let's say it's for 100 shares, oftentimes the vesting schedule, the standard vesting schedule, as we call it here, I think in the slide, it's a 4-year vesting period, which basically means if you leave after 2 years, you're only halfway through that vesting schedule. So of those 100 shares, you would only have the right to buy 50 of those, basically if you left right at your 2-year anniversary. Another piece of this is most startups, they will have what's called a cliff at the beginning, a 1-year cliff. So in other words, if you leave on month 11, you don't have any shares vested. But as soon as you hit your 1-year anniversary, automatically 25% of your grant is vested. And usually after that cliff, you move into monthly vesting, where every month you'll get 1/36 the remaining until the full 4 years. In our example, the full 100 shares will be available to you to buy if you want to. All right, the final piece that you'll see on your grant is the option expiration date. And just as this name implies, this is how long the option is good for. You'll notice that it will usually say 10 years. This would suggest that if you received your options and 10 years later, you're still an employee at the startup and they haven't gone public and there hasn't been some other liquidity event, you're going to have to decide if you want to exercise your option or not. Usually what happens is if an employee leaves the company, they change jobs or they move on, you have a 90-day period to determine if you want to purchase the shares that have vested. So let's say that you leave, in our example, after 2 years, and you had 100 shares in your total option grant. So after 2 years, you have 50 that have vested. What that means then is usually over the next 90 days, you have to decide if you want to purchase all of those 50 shares, any lesser number of that 50, 10, 30, you can buy whatever you want, or none. But after 90 days, your right to buy those vested shares is gone. Right. So that is an overview of really what we cover with our clients, and specifically, again, the recipients of the options, the employees that are clients. And it's all of these terms you'll see as an option holder when you log into Carta or when you receive your grant. So this gives a little more understanding of what you're looking at and what your rights are. And usually at this point, we take questions from our clients. We have the employees that listen to this and sit through this, and they have some specific questions, which I think we might even have some.
All right, Ryan, that was great. Thanks. So as this is normally the question and answer section, we are not live with an audience, but we do have some commonly asked questions and have kind of a list here of what may have come up. And some of these are questions, of course, that you covered. Maybe you'll get a chance to dive a little deeper. I'm sure that happens a lot where you actually have to answer a question that you actually covered. I'll do the same here. Let's see. All right. So Ryan, what happens to my vested shares if I leave before my vesting schedule has ended?
Okay, good question. So if you leave before the full, let's call it 4 years are up, and so you haven't completely vested your shares, you have the right to buy the vested portion. So again, let's say you leave 2 years into your 4-year vesting period. You have now 50% of your grant that has vested, and you have to make a decision. And oftentimes you have to make this decision with not a lot of information because the company's private. You may not have access to understand if they're fundraising or if there's an acquisition in the future. You really need to make a decision to decide if you want to put money toward buying your vested shares. Sometimes this can be a significant amount. It all depends on obviously your individual situation. But what you need to do is look at the number of shares that have vested. So again, if we say that you leave right at 2 years, it's very simply half of your grant. And then the strike price per share. And if you multiply those two things, that's what it would cost you to buy the entire amount of your vested shares. And as I said in the presentation, you can decide to buy 10% of that, no percent of that. You could walk away and just say, I'm done. And you don't have to do anything. It's literally your option. You still think of the term option. It's your right, not your obligation to buy these shares. So you need to make a decision. And you usually, again, have 90 days from the day you leave to decide if you want to write a check to buy some or all of those vested shares.
All right. So what happens to my stock options if the company is acquired?
Okay. If your company is acquired while you're still an employee and your options are vesting, usually what happens is whatever shares you have vested are going to be acquired by the acquiring company. And how it impacts you is it's called a cashless transaction or cashless exercise, because you're selling your shares to the acquirer at the same time that you're exercising your option to buy them. So let's say that you have the right to buy them for $1 and the acquirer wants to come in and buy the company at $2 a share. So essentially the cashless portion is that you just receive that difference. You receive the dollar per share without really having to technically write a check to buy them first. You just get the difference. You get the increase in value per share. Now that leads to a question about what happens with my unvested shares when there's an acquisition. Usually your unvested shares will get returned back to the pool. And now the acquiring company needs to figure out how to incentivize you to stay in the new business. So a lot of times you'll see that new company come in with new stock option grants, new reasons to keep you to stay. Almost always, especially in startups, part of the reason to make the acquisition is the team. They want you to stay. So the acquiring company will come in most often and say, hey, you've cashed out on these options, but here's new options in our new company. And we want you to start. They want to incentivize you to stay. Sometimes what you'll see is there's acceleration, investing specifically when an acquisition takes place. It could be based on your position in the company. We'll see very senior people even have sometimes acceleration that will give them accelerate their entire vesting clause. And oftentimes what's called a notion called a double trigger, where if the acquiring company all of a sudden wants the head of sales to relocate to the East Coast, or wants the head of sales now to step down to being a senior salesperson. It's effectively called like termination. Your role is changing, not because of cause. Certain triggers like that you'll see built into some employment letters, where that will result in an acceleration of shares that haven't quite vested just based on the passage of time.
Ryan, can you explain to me what early exercise means?
Yeah, so early exercise really is what it sounds like. It gives the holder of the option the right to buy their shares early. So really to own them before the vesting period would normally say that you can buy them. This is often reserved for early employees or very senior employees. If you see a startup that's got 50, 60, 70 people, they're probably not offering early exercise anymore. What it results in, and this is a term a lot of people ask about, if you decide to early exercise, which is to, again, buy your shares before they're vested, two things happen. One, you have to file what's called an 83B. An 83B is a document with the IRS, and there is no forgiveness on this. It is a very strict, you got 30 days to get this in. And if you decide to buy your shares early, you have to make sure you complete that 83B. This is another area where a platform like Carta has just made a tremendous difference for the good. It used to be a very hit or miss if employees, because it's the employee's responsibility, even though the company really tries to ensure they don't miss that 83B submission. A lot of times it would get missed. Carta, you can't miss it. It really forces you to stay in there. So the reason that an option holder would want to take advantage of early exercise, if it's offered, is very simple. It allows you to own the stock earlier. So if you think about the tax treatment, right, as with any investment, like we talked about, if you hold that stock for more than 12 months before you sell it, you get to pay at the long-term capital rate tax. So in a cashless transaction, like we talked about, where it's usually a buy and a sell in the same moment, your holding period is less than a day. So clearly you're going to be paying short-term capital gains. But if you can time it right and you have the access to early exercise and you take advantage of it, you essentially start your 12-month holding period clock at that point. So where if the company gets acquired a year later or 2 years later, you are in long-term capital gains, which is at a smaller tax bracket.
So I'm receiving my stock options at a strike price. What is that price? How does that get set?
So the strike price is usually established by what we call a 409A valuation. The 409A valuation is a very technical accounting term that the recipients don't really need to worry about. It's set in advance. It basically represents the fair market value of the common stock at the time that the grant is issued. And that, in a startup, for the most part, that price will stay for 12 months. Because unlike a public company where the value is efficient and buyers and sellers are setting the price daily, literally throughout the day, a privately held startup company might only see a change in value at the next funding round. But until then, there's not a lot of ability to measure the dynamic change of the value. So when you have a strike price set by this 409A valuation, it's generally good for 12 months. I say generally because if you do a 409A and then 6 months later you raise a new round of financing, that takes precedent. That is a much better indication of your current value. But absent a funding event, you're going to have the same fair market value price for those 12 months. And so if you're receiving a grant, in month 2, and your cube mate or your now work at home mate is receiving a grant in month 6, chances are you could have the same strike price.
So in my grant, it tells me the number of shares that I'm potentially receiving after vesting. What is that? What should that number mean to me? How do I think about that number? How do I value that number?
Yeah, that's a good question. And in itself, the number means very little. It's really what is that number as it pertains to the full number of shares that are available. And we call that the fully diluted shares outstanding. A simple example would be, let's say that I'm the recipient of a grant for 100 shares, and there's only 1,000 shares in total. That means I have a grant for 10% of the company. Right? However, if I have a grant for 1,000 shares and there's 100,000 shares outstanding, fully diluted, that's only 1% of the company. So the number of shares in itself is very hard to gauge. You really need to ask the question, and an employee has the right to ask, and really they should, is, okay, great, number of shares, I understand, thank you, but how many are out there? Right? What you want to know what the percentage ownership is that you're receiving. Because otherwise it's really hard to understand, is the 100 a good amount or is the 1,000 a good amount? You really don't know unless you understand the fully diluted shares. And then as a company grows, you're often going to be subject to dilution. So even if you receive your grant and you have, say, 0.5%, that could change if the company goes through subsequent funding rounds. Because what happens is more money comes in, which means more shares have to be sold. So again, it's that bottom number, that total available number will increase, which means the number of shares you have now is a smaller percentage. But that's not necessarily a bad thing. People get really anxious about dilution. But I always try to remind people that dilution generally means that someone else wanted to put their money into the business. It's a good thing. And without dilution, it's really hard to increase value. So what you want to look at is the total value of the company and how your ownership pertains to it. Just because just because you're getting diluted and your percentage of ownership maybe is going down, what you want to see is that's just the flip side of the fact that the value of the company is increasing even greater. So dilution is not necessarily a bad thing. And actually, for a company to be successful, you are going to move through some dilution rounds as they bring in that growth round of capital, or ultimately that final mezzanine round of capital, or even going public. It means you're going to be diluted, but it means you're going to have a more valuable number of shares that are in your grant.
Kind of ties in with what you mentioned earlier about stock options are designed to align everybody in their incentives, and everybody, you got to keep in mind, everybody's getting diluted, from the founders to the previous investors. That it's all a good thing in general,
Yeah,
for the most part.
Dilution is only a negative thing if it goes along with a decrease in value of the overall business.
Right, it aligns everybody to keep building value in the business. Correct.
About execution, and that's very aligned. Everybody's aligned to execute together.
Right.
So. Great.
All right. Thanks, Ryan. Very informative, very helpful. Founders that are watching this, I would just urge you, don't assume that your employees understand stock options as well as you or your founding team. They do need a conversation. They do deserve a conversation. So, Ryan, thanks for a little bit of that conversation today. We'll see you on the next episode.
Thanks, Trey. Appreciate it.